Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action. All right, today we have Rob Beardsley with us. He is the founder and principal of Lone Star Capital. Rob, thank you so much for coming out to talk with us today. We usually start out by having you just kind of tell us a little bit about yourself. How did you get here?
Sure. Thanks, guys, for having me. So as you mentioned, I'm the founder of Lone Star Capital. My business partner and I, we started the company 6 years ago to focus on owning and operating Texas multifamily. So we've started acquiring property in Houston and then continued to build on that portfolio and branched out to other markets in Texas, but it really stuck to our niche of workforce housing in Texas, in the major markets of Texas. And up to this point, we've acquired almost $650 million of property. And we also have built an in-house property management company. So we're really proud of, where we are, where we've gotten so far in the last 6 years. And prior to starting the firm, I was actually in college. So when we got our first deal under contract, I was a sophomore, dropped out of school. And from there, it was kind of just off to the races to try to prove out the venture as a going concern. And so far, so good. So we're just going to keep trying to keep moving forward and take whatever is thrown our way.
Wow. So you jumped right out of college into syndicating real estate.
Yeah, it was a mix of ambition and courage as well as ignorance that, allowed me to take that jump. And in a way, I was lucky to not know what I didn't know, because if I knew how hard it was actually going to be and all the challenges that I would face, I probably would have been too scared to do it. So the naivete at the time allowed me to just say, all right, let's do it.
That's an awesome story. You mentioned the naivete. What do you think you were naive about, and how did that help or hurt you?
I think real estate is a very relatable business, and people live in it, people work in it, people shop in it. So real estate's all around you. So I think people underestimate its complexity because they spend so much time with it. The familiarity of it makes it less intimidating than it really is. The thought of buying an apartment building and there's already tenants there, it provides cash flow. You can hire a management company. They'll manage the property for you. It sounds pretty straightforward. But when you actually start getting involved in the business, you realize every step of the way, there's so many pitfalls, so many complexities, and it's really so much harder than you think. So for me, the hardest part and my biggest mistake was just underestimating how hard it is to raise equity. I think everyone overestimates that, and they think, well, if I have a good deal, of course, I'll be able to find investors. And I know some rich friends, and I have people in my network that I can go to. And the reality is, getting people to give you money is a very, very, very difficult thing, especially when you're 21 and a college dropout and you've never done it before. So it's like with everything, the first one is always the hardest. And my business partner and I, we just underestimated it. We just were so fixated on the real estate and on the business plan and on finding a good deal that we didn't nurture relationships, and we didn't prepare for the equity raising portion of the business, which I think it frankly is one of the most important parts, and you have to be focused on it full time. Someone has to, at least.
So being so young, like what did you do to overcome kind of those challenges that you had?
I think the biggest thing is just utilizing partners and filling the gaps that we didn't have. My business partner was older than me and had corporate experience. He came from a 12-year career as a tax attorney and worked for PwC and MetLife. So he had more of a business professional network. He had professional experience. So he brought that element to the table, which was great. And he brought, a little bit of gray hair to the table, which is great. However, neither of us had much track record in multi at all. He had done some deals, and my family has a background in real estate. So we had done a little bit in multi as well. But with that being said, we had to rely on a good third-party property management firm that would partner on the deal with us, that would sign on the loan, that would bring a lot of the elements to the table that we didn't have. And I just named a few, right? Property management and loan guarantor. Those are big things. And the loan guarantee thing is a big one that a lot of people don't even realize when they want to get started in real estate. You have to check a lender's boxes from a net worth, liquidity, and experience standpoint. And it's very unlikely that someone new to the game brings all three to the table. So it's likely that you either have to go small and start with smaller deals and build your way up, or you have to bring a partner in who has those elements, who can co-sign on the loan with you. And that's what we did. We jumped in and did a $15 million deal as our first deal. And, what that ended up having us learn a lot on the fly and also make mistakes, and also have to bring in a lot of partners and share the pie with partners and end up with a lot smaller piece of that bigger pie. But in the end, I think that worked out for the better, because who really cares how much money you make on your first deal up front or on the back end? It's all about just getting off the ground.
It's true. Like, making a step forward is sometimes better. It may not be the largest step forward that you want to do, but like just making that step and moving in the right direction is good. So you mentioned bringing on like these partners. Like, can you maybe talk a little bit, like, how did that conversation go? How did you find them? Like, what kind of, how did it work?
A lot of the networking success that we have now is similar to what we were focused on at the beginning, which was attending the right conferences and getting lucky in a way and finding the right people to connect at those conferences, making a good impression, doing good follow-up. People are everything, I think, in this business for sure, but perhaps in all businesses. And so we focus on relationships, focus on our reputation, and putting ourselves in front of the right people. And it's a very humbling experience. And I think that's a healthy experience, because way back then you had to leave your ego at the door and just be willing to put yourself in front of anybody, pitch yourself in front of anyone. I'm not one of those guys who, if I'm at a bar, I just have this comfort to just walk up to anyone and strike up a conversation. I'm not that guy. I'm more so a wallflower, if anything. But hey, guess what? When there's business on the line, money on the line, you can't pretend to be anything but an extrovert, right? And so I just remember kind of forcing myself at conferences, go up to people, shake my hand, forget that I have a squeaky high voice and I'm only 21 or whatever it was, just put myself out there, be humble, and be willing to ask for whatever it is that I want, and be willing to ask for referrals as well. So that was, did we have a productive relationship with everybody? Absolutely not, right? But it's just sheer volume and just persistence, which unlocked many doors.
For sure. So I'm hearing, like, going to conferences, meeting people, networking. What I'm also hearing, though, which maybe you didn't say in so many words, is like you kind of went to the conference and had a goal, or like knew what you needed, right? Like you had gone through like some sort of process and you're like, man, I really need this sort of person, this type of this business or something like that, to really like kind of go meet that person? Or did it just like fall in your lap?
Yeah, that's a really good point. And I think whether you learn it on the front end or learn it once you bump your head against the wall and figure out that you have an issue that you need to solve, either way, it's going to lead you to that path, to the right path. But I think it certainly is better if you can prepare in advance of the roadblock. But we didn't, like I said, we didn't know in many cases. So we were learning as we went. But in a perfect world, you would have a mentor, you would do the studying. And I feel like information in this space has only become more and more accessible with more online content, with more in-person content. I mean, it's a very collaborative space. So I know just from the content that I put out on my different channels alone, someone could just absorb hundreds of hours of in my opinion, really valuable stuff and cut a lot of time down to their path. But with that being said, it's so much better if you could just prepare beforehand, right? Get the knowledge beforehand, know the team that you need to put together, know the pieces of the puzzle that you'll have to bring to the table in order to get where you want to go. But we didn't I can't say we really fully had the picture first and then went and did it. We just kind of went along the way and put one thing together at a time.
Sounds like you weren't. Failure was a possibility, but like you had somewhat of that young confidence that like, you know what, we're gonna do this and we're gonna just see how it goes, and it's gonna be okay. Having that kind of like self-reliance, self-confidence, I think is what I'm hearing.
I've got a question, Rob. So you mentioned that it would have been nice to be prepared. Are there a couple lessons along the way, as you were kind of learning how to do it the hard way, that you can share, that you may have learned while you were kind of going through that volume of interactions and just really trying to figure out what you actually needed? And
yeah, for sure. There's a lot. Like going back to relationships, you really need to build relationships for the debt side, for the equity side, to get deals, to manage the property, right? Whether you're building your own management company or more likely partnering with a management firm to begin at least. And all those things, it's helpful to have a deal. Conversation flows a lot more smoothly when there's a deal to be discussed, but you don't need to have a deal to talk to a potential partner. You can talk to a lender and build a relationship with a lender in anticipation of a deal. You can do the same for investors. You can do the same for a property management firm. So it goes back to, I think, a really classic real estate lesson, which is do things when you can, not when you have to. And time moves a lot faster once under contract. So you want to do everything you can prior to being under contract. So that way, when you actually are under contract, you're not scrambling and doing a million things. You're focused on the key things to actually get to a closing. So for us, that was, all the things I said, but really specifically building relationships on the equity side and figuring out a legitimate path to raising capital. Because sitting back and thinking, well, if I find a good deal, the money will come, that's not going to serve you. So I wish that I would have addressed that in a more serious manner and built out a structure and a process that like we have now, as far as courting investors, bringing investors in, communicating with them, nurturing them, and really building out a network. I know that you can't do that overnight, but I wish I would have started even sooner. So that's a really big one for me.
Really good like thought of building your systems and processes like when you have time to do it. Often you get under contract and then it seems like you're right, like time just speeds up. It's like, okay, we've got the inspection, we've got all the lender inspections, like all this sort of stuff, and you got to raise capital. Like having that stuff set up beforehand in a process and really kind of getting an idea of like what size deal you can do. Do you mind sharing kind of like when you're not in a deal, what you're doing to like nurture those investors? And one thing Chris and I have always kind of wondered is like, okay, like how much money could we raise? We've been successful in all of our raises so far, but like how big could we go? Do you have any way of like kind of determining that in the off time?
I would say no. I would say the only way you can really know is from your raise experience over the last few deals. And it changes from deal to deal, right? And you guys have probably observed this in your business as well. The start of the year kicks off, there's excitement, and raising capital is a little bit easier at the beginning of the year. People have their New Year's resolutions. And then maybe there's a little bit of a lull after that. And then things pick up again. Then in the summer, things slow down. And then towards the end of the year, things really slow down. But then at the same time, you've got people who are trying to make year-end investments. So throughout the year, it's very cyclical. And then the other thing to keep aware of is, depending on who your investors are, they could be tapped out, right? They could make a $50,000 or $100,000 investment, and that could be all the investing they plan to do with you for that year. So for us, I think it's just a gauge as we go through deal after deal. We figure out, oh, wow, this didn't go to plan, or, this actually went really well. And also, you never know which deal is going to resonate with investors. You might think that a certain deal with a certain profile might speak to investors and do really well, but it might end up not being the case. So I would say, unfortunately, the best way to learn all that is just through actually raising capital and the act of doing it to collect that data. But in between raising capital, you don't want to just have a silent period where you're not communicating or anything, right? You're always nurturing, you're always showing and giving value. So for us, we have built a content machine. So we're very proactive and create a ton of content and make sure to share that everywhere we can, make sure to provide value to our investors that way. Monthly newsletter, very transparent and robust monthly and quarterly reporting on the deals that we have in the portfolio. So we look at everything as an investor relations moment. I preach to our team that I don't care if you're not on the actual investor relations team. If you're in asset management or acquisitions or accounting, you are still investor relations. Everyone is doing investor relations.
That's such a key point. So do you mind if we shift the conversation on to acquisitions and setting up a capital stack and what you're really, what you were doing a couple of years ago, and then how you've adjusted and what you guys are doing now?
Yeah, for sure. I mean, one of my favorite parts about this business is it's ever evolving and the market's always changing. And so we try to adapt. And if I don't want to tell too much story time, but if we go back to 2020 and 2021, when interest rates went to zero, the market got extremely competitive. Debt capital was widely available. It was a very difficult time to be in the market if you didn't utilize cheap bridge debt, which made us lose out on a lot of deals, but we also won deals and we bought deals during that period, which turned out to be a tough time to be a buyer because of the fact that that was a cyclical high in pricing as well as a cyclical low in interest rates. And then nobody anticipated this, but interest rates spiked on floating rate borrowers, and that put people in difficult situations. So we're really fortunate to have a mitigated or isolated floating rate issue in our portfolio. We only have 3 floating rate loans in our portfolio. So we've been managing those to the best of our ability. So I'm really proud of our portfolio and the position that we're in. But that still nonetheless has been a challenge for many people out in the space. So fast forwarding to where we are now, that we have kind of the end result of that regime change, if you will, as far as interest rates. Now we have high interest rates, both on a fixed rate and floating rate basis. And while prices have come down, I would argue that they haven't come down in lockstep with interest rate movement. So a lot of people, 2023, I think was the word of the year was positive leverage. Investors wanted to see a deal with positive leverage to get them comfortable to invest. And there was some positive leverage to be had on a limited basis, which to define that is you're buying a cap rate that is greater than the interest rate on the debt. That's positive leverage. And that's a sign of perhaps a healthy buy or a good cap rate purchase. Do I think that's the end all be all? Absolutely not. I think there's plenty of great deals that have gotten done throughout history at negative leverage. And especially if you're buying in a growth market, it's most likely at negative leverage, but I digress on that. Like I said, the issue where we're at today is most deals are negatively levered. Floating rates are high, fixed rates are high. The 10-year treasury has been extremely volatile, which makes getting deals done today really tough for fixed rate borrowers. And, the reason for that is we've pivoted to mostly a fixed rate strategy from kind of the highs of 2021. And I think that's been because of an adapting to the market, but it's also because, hey, we've learned our lesson that, playing with floating rate debt is challenging and is more risky. And that's not necessarily what we want to be doing all the time. I think on a selective basis, yes, it can make sense, but generally speaking, we want to help our investors sleep well at night. And by fixing your rate, that's eliminating one variable. So that's all great to say, and that sounds great, but actually putting into practice is very difficult, especially when the 10 years at 465 today. So not that floating rate's any easier. So anyway, that's a lot of rambling because I don't really have a great note about how to get a deal done today, just given all the volatility. But yeah, that's kind of where we've been tracking through the last few years.
So would you mind kind of breaking down the benefits of floating rate debt and the benefits of fixed rate? I mean, now every investor that we talk to wants fixed rate debt, but that also comes with some unfortunate consequences, lower returns specifically on our side. I'd be interested to hear how you guys kind of interpret that.
Yeah. And you're absolutely right. And the pros and cons of a fixed rate are, the fixed rate pro is you get a fixed rate. So you're not taking interest rate risk for the term of the loan, which that can be a pro, but that can also turn out to be a con in itself if you're locking in a high rate and then rates go lower, or you're missing out on that benefit. The con that's the most straightforward on a fixed rate loan are the more onerous prepayment penalties. So that can lock you out of being able to be opportunistic and, let's say, sell or refi a deal when the interest rates do come down. So not only are you potentially locking yourself into a higher rate, but if rates do come down, you are perhaps locked out of that benefit because of the prepayment penalty. So that makes things tricky on a fixed rate side. On the floating rate side, you obviously, the con is you have full interest rate risk and exposure. Obviously, you can buy an interest rate cap, which is a partial hedge, but those aren't cheap and they're not perfect. So they're not a fix, in my opinion. They're a helpful insurance, but that they're not a perfect fix. And then, of course, the benefit of a floater is you have much more flexibility. You can exit the loan for a minimal penalty at any time, pretty much. So you can really be as opportunistic as you want. The kind of diving into the nuances of today, given how inverted the yield curve is and was, right? The treasuries have run up, which is now balancing out a little bit where floating rates are versus fixed rates. But when the yield curve was deeply inverted, where you had a 5.3% SOFR rate, which is your floating index rate, and you had a 4% 10-year treasury, it really made a ton of sense to fix, at least for a shorter period of time. And the reason why I say shorter period of time is because historically speaking, when you do have an inverted yield curve and it's actually cheaper to lock in a fixed rate than a floating rate, that usually means that floating rates are about to crash. And it hasn't yet, but it's going to take time. It will most likely floating rates will come down and we will see a steepening yield curve eventually, which means floating rates will be less than longer term fixed rates. So, I think for a 5-year loan, it made a lot of sense to lock in a 5.5% fixed rate rather than having a 7.5% floating rate, right? That just makes a lot of sense. But today, now with fixed rates running up, now all of a sudden you can think, well, maybe it makes sense to float because we're already at a high, and maybe it makes sense to float with a high starting rate, but then float my way down to lower rates. So a lot of people are in fact making that bet, but I do agree with you that that is a harder story to sell to investors.
Yeah, and one of the things that we kind of struggle with is raising capital for capex, so capital improvements, and raising with floating rate, you kind of have a little bit of an opportunity to raise a little bit less and then on refinance, or to keep those returns a little lower, or sorry, a little higher. But when you go with fixed rate, you need to raise all that capital up front. And I mean, essentially, no matter how long that capex project takes, you've just got that money in the bank.
Yeah, I mean, and that's true as far as using debt to finance the capex, right? Through usually a bridge loan. Sometimes you can get a permanent loan to finance capex as well, but that's more difficult. But the third option there, like you mentioned, which would be a bridge loan, the challenges are it's usually floating, right? And floating index rates are higher, and then spreads are wider on bridge loans. And today it's around, just use rough numbers, 200 basis points wider in spread to do a bridge loan versus a permanent loan. And so the challenge there is, while you can get all the leverage you want by way of a bridge loan and they'll finance the capex for you, the challenge is, of course, the cost of that capital. And you have to look at that cost and look at the business plan and the deal you're buying and go, okay, is this cost equate to a good deal? Am I getting enough return on my cost there from a deal? And, given where pricing is today and where the potential to push rents are, it's really tough to make those numbers pencil. So I think those are can you make a deal work in any of these three scenarios? Yes, absolutely. But is it easy? No.
And now here's a word from our sponsor. Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
Are there any deals that you guys are actively pursuing, kind of interested in, that you, I guess, kind of share your thought process on developing the capital stack, or maybe one you've done in the past?
Yeah, sure. We've closed a deal recently, and we're working on a couple more right now. The deal we closed a couple months ago was a fixed rate, 5-year Freddie Mac fixed rate loan. And so that kind of speaks to one of our strategies that we've been successful with. We did a lot of 7-year Freddie fixed deals in 2023. And then we started off this year with a 5-year deal, because as interest rates went higher, our rationale is, okay, we still want a fixed rate, but we don't love the rate. So let's fix it for a shorter amount of time, right? If you're locking in, I mean, think about the people who locked in a 3% rate in, 2020, and they got a 10-year fixed rate loan. That's incredible. That's a real dream come true. But as rates are going up to 6%, now you're thinking, well, do I really want to lock in a 6% rate for 10 years? Yes, it's possible that rates go higher than that, but it's also possible that they don't. So the desire to lock in a long-term rate is not really there. So we went with a 5-year fixed rate there. And we actually were really fortunate to lock the rate when treasuries were much lower than they are today. So we locked the rate at 5.72%. So we were very happy, and we did achieve positive leverage on that deal. So anyone who didn't invest in that deal, they're missing out. The next couple of deals that we're working on now, we're doing another Freddie fixed rate deal. So continuing that strategy, but rates are moving higher. So it makes it even tougher, and we have to be more selective and find the right buys and make sure we have the right business plan. And then finally, we also are working on a deal that we are acquiring on a bridge loan. So this is an older property. It's a property that needs a lot of love. So we're actually budgeting over $4 million in renovations, which is about almost $20,000 per unit. That's a big renovation budget. And like you said, we certainly could raise that out of equity, but that would be very low leverage. And while it would be lower risk, it would also be dilutive to returns. So we are opting for a bridge loan there because we feel like the business plan creates enough value to cover the added cost of the bridge loan.
So when you're calculating that, the debt for the bridge loan may be like 9 or 10%, but the return of the overall project, I mean, there is kind of like a positive leverage there when you're talking about, essentially there's a margin of that 10% debt and maybe a 18 or 20% return. Is that kind of like what you're looking at when you're raising those capex funds, pulling out the bridge loan for those capex funds?
Yeah, that's a fair way to look at it. I mean, we look at it a few different ways. So you can look at the unlevered IRR of the project. So that just means, okay, what would be the return of the deal if I just bought it all cash and 5 years from now sell it? And unlevered returns have come up a lot over the last few years because as prices have come down. So unlevered returns they were as low as like 8% for a lot of deals, but those deals still work because debt was so cheap. If you were financing at 3%, 4%, an 8% unlevered return was great. But now 8% unlevered return, and if you're financing at 9, 10%, like you said, that doesn't make any sense. Yeah, it's not going to work. So you need 12, 13, 14% unlevered returns to then go lever those returns up by a 9% debt. And now you've got something to work there. The other way we look at it is not from an unlevered IRR perspective, but from a yield on cost perspective. And that's an even simpler equation because all you do is you take your stabilized NOI, divide it by the purchase price plus capex, and that's basically your future cap rate that you can potentially own the deal at. So you want that future cap rate, your pro forma cap rate, or your yield on cost to be, certainly higher, a decent amount higher than where the market is. Otherwise, what's the point of doing all this work and taking all this risk if you could just buy a deal as is and kind of achieve a decent cap rate, right? So if we were to say that today you could buy a deal for a 5.5 cap, you would definitely want to push the yield on cost north of 7, and that will achieve a return, right? That's enough of a spread that gives you a good return to make sense of doing a bridge loan.
Interesting. I had a question for you on the unlevered return. How does that compare to cash on cash for a deal?
Yeah. So the unlevered IRR would be all the cash flow from a deal, including the appreciation upon sale. Whereas obviously the cash on cash would just be the cash flow. So if you're looking at cash being positive, levered on a cash flow basis, if the deal is, a 6 cap deal and you're financing at 9% or 8%, that is obviously not going to help cash flow. That's actually going to minimize your cash flow, basically. So you're going to struggle from a cash flow perspective. But if that same deal is cash flowing at 6%, if it has a big upside potential and the unlevered return is 14%, well, now 14 is obviously greater than 9. So you can justify it and make sense of it. Some people may consider that untenable for them or too risky for them. And I don't disagree. I think that makes perfect sense. But there's a deal out there for everyone. And, I'm maybe a little bit surprised, but I'm seeing a lot of investor appetite actually for bridge loan deals because they want to pursue the higher returns. They would rather take the chance and go for the higher return rather than just lock themselves in on a fixed rate on a longer term basis and just lock in a lower return.
So kind of continuing my question here, maybe, and maybe kind of jumping subjects a tiny bit, but so with the given market the way it is and kind of, the assumption that interest rates are possibly at their highest right now, have you changed any of your assumptions in your underwriting to work these deals? Specifically cap rates are up and, are you looking at in the future the cap rates possibly coming back down or still modeling, a 1% increase in cap rates? Have any of those assumptions changed in order when you're looking at these deals?
Yeah, it's a great question. And generally speaking, we try to not imbue our underwriting with our personal beliefs about the market and the future, right? We're not trying to build investments based on our predictions of the future.
Sure.
But with that being said, when you use an exit cap rate, you are making a statement about the future. And if you want to just be as by the book as possible, you would just take the market cap rate today, and then you would expand it by 50 to 100 basis points, and that would be your exit cap. And I think that's a good rule of thumb. But the challenge with today, like you said, is we are likely around the cyclical high for cap rates. And I would say the biggest change that we are making is we are comfortable underwriting a neutral exit cap, if not even a compressed exit cap, which in a different environment, that would be considered very aggressive. In this environment, I think that's just necessary to make deals pencil. But it takes a lot of guts and courage. And we could be wrong, but I think what's going to happen is the people that buy the right deals in 2024 and 2025, they're going to be the ones that had the guts to underwrite cap rate compression. And then in 3 years from now, 5 years from now, they're going to look like the geniuses in the room that were like, oh my gosh, I can't believe you bought in 2024. That was a crazy time. That's like people that bought in 2010, right? People don't even think it was fair. Like, oh my gosh, if only I was in business in 2010, I would have crushed it. But the reality is you wouldn't have crushed it because you were going to be too scared because you would have had to underwrite cap rate compression, right? It's all about emotions and being fearful when others are greedy and vice versa. So that's the biggest change, which I think you smartly pointed out. And the other thing too is with all this kind of bullishness that I just mentioned about cap rate compression and buying good deals this year, I think on the flip side, I think that from a fundamental standpoint, I think multifamily has some headwinds. There's a ton of supply nationally, and in certain pockets, rent growth has been negative. It seems like we'll see what happens there, but it's also very likely that the U.S. economy slows down. It hasn't even been 23 months since the first rate hike, and that's historically speaking when a recession usually starts, is 23 months after the first rate hike. So come this summer, we're statistically in for a recession. Similarly, the yield curve has been inverted for the longest period in history, and yield curve inversion is the single best indicator for a recession. So that's another pointer. So it is, in my opinion, very likely that we see a slowdown of the U.S. economy, which will, of course, trickle into multifamily rents, concessions, collections, vacancies, and that's going to hurt NOI in the near term. I mean, yeah, go ahead.
Sorry, I'm gonna interrupt you here. So what I'm hearing from you is like you're looking at compression of cap rate or neutral, but on the flip side, it sounds like you're modeling less than normal increase of rents and possibly higher increase of expenses along with that. So kind of like on your assumptions, like you've mitigated more risk in some areas and taken on a little bit more risk in some others. Is that kind of what I'm hearing?
Yeah, that's right. I mean, basically our house view is that over the next 2 years, you're probably not going to be able to get your $400 rent pops that you could have gotten before.
Yeah, so unless it's like a huge value, unless it's like a huge value add, right? Like unless you're taking like a CD class up to like a B class, like where it's a forced rent increase, right? Not just like the typical assumed rent increase for, year on year raising rents, right?
That's right.
Yeah.
So Rob, I have a question about cap rates and just like how you guys view them. So, there's a lot of different types of cap rates. So, when you're looking at the existing financials or the trailing 12 and the NOI that's producing, if you divide that by the purchase price, that's going to give you a cap rate. Or you can take what you think you're going to make in the first year and divide it by your cost to acquire the property. That's going to yield a different cap rate. How are you guys using those types of cap rates to determine, the exit cap?
Yeah. So for us to get a gauge of where the property is today, we will use some sort of annualized, normalized trailing revenue. So we might use T3 for vacancy. We might use T12 for other components of the revenue of the property. So we kind of put together a massaged, what we think is a fair reflection of revenue. Because, if you use, they might have had a vacancy bump or something, who knows? So you kind of want to smooth things out and get an honest picture of the revenue on a trailing basis. And then we pretty much take the seller's expenses, throw them out the window, put in our expenses, and that's how we calculate the trailing NOI. And then we cap that using the purchase price. And that's what we believe as the true going in cap rate of the property. Now, with that being said, that doesn't tell us the full picture about the market cap rate and the exit cap rate, because when you buy a property, especially a value add deal, you're most likely paying a compressed cap rate. Like, for example, the deal that we're buying right now, where we have a big business plan, we're going to raise rents, we're going to do a lot of work to increase the income and the value of the property. The seller's not an idiot. They know that we're going to do all that stuff. So they can price their property accordingly, and we're going to be willing to pay more accordingly, right? Because we know that there's this lucrative business plan on the other end. So we're actually going to pay more for the deal. And that's not just us. That's how the market operates. The market will pay more for the deal and therefore pay a lower than market cap rate for the property in order for the opportunity to do the value add. So it wouldn't be fair for me to look at my entry cap and say, oh, all right, well, that's the cap rate for the market, because frankly, I'm paying a below market cap for the value add. So because the reality is in 3 years or 5 years when I sell that asset, is that going to be a value add deal in the same way that it is today? Maybe not. Maybe the market grows so much that the kitchens are ready to be redone again in 5 years and it becomes a value add again. And that's certainly possible. But to be more conservative, you have to assume that I'd be selling a stabilized property on the back end. So I need to identify what the stabilized cap rate is for the market. So I need to kind of either figure out comps or look at other deals that we're underwriting in the market to determine what we think is actually more of a reasonable market cap rate today for a stabilized asset. And then you can either expand that or contract it or whatever to determine your exit.
So essentially what you're saying is on a large value add deal, the going in cap rate is not that valuable for predicting the exit cap.
Yeah, to an extent, yes.
And so your process will be to look at comps and then, it like in a more of a normal time in the cycle. I mean, you mentioned that cap rates are kind of nearing what we all believe is an all-time high, but it's potential we could still be on the way down, but more in the middle of the cycle, you guys would add 50 to 100 basis points onto the cap. But for a value add deal, you'll be looking at comps and kind of generating a market cap.
Yeah, that's right. Yeah. And that's the benefit of being focused is we look at a lot of deals in the same markets, in the same locations. So we have the benefit of that in-house data of us looking at so many similar deals.
Awesome.
Yeah.
Well,
I mean, it certainly sounds like you guys are experts. So, well, I think we are getting towards the end here. So I'm gonna start us off. We've got 4 questions that we typically ask everyone. And Rob, you're too young for my first question, so I've got to modify it. So normally it's what's one piece of advice you would give to your 25-year-old self. But I've got to change that to your 20-year-old self.
That's fair. I appreciate that. So I'd just like to go back to my earlier point about raising equity and drill into building a brand. And this is hard advice for anyone to take, and especially someone as young as I was at 20, because whoever you're talking to and giving this advice to, they're going to feel imposter syndrome. And I'm sure you guys have felt it at one point, and I've felt it and continue to feel it at times. And I think it's healthy, because if you're not feeling imposter syndrome, that probably means you're not pushing yourself to become a better version of yourself, right? You're just staying in your comfort box. And you need to, so my advice to my former 20-year-old self would be lean into the imposter syndrome, become more comfortable with who you are, and build that brand, expose yourself, because I was reticent to create online content, to put myself out there, to be a person to people, right? I just wanted to hide behind an email or hide behind a spreadsheet. But the reality is, back in those days, instead of hiding how young I was and hiding my inexperience, I should have just gotten my phone out and made a video like this, look right into the camera and say, hey guys, I'm a 21-year-old college dropout and I'm building and I have $100 million multifamily portfolio and I'm looking to build X, Y, and Z, right? I should have just been honest and just really build a personal relationship.
That's really cool.
Yeah, that's great advice.
So, Rob, can you share with us your first entrepreneurial endeavor?
Yeah, absolutely. So I haven't always been necessarily the most entrepreneurial and have, built a lot of businesses when I was younger, but I always have been attracted to finding smart ways to make money rather than just, work a minimum wage job, right? So when I was really young, my sister and I, we recognized that we had a backyard overgrown with cherry tomatoes. And so we started to bag them by the pound. And then instead of having a lemonade stand up front, we just sold tomatoes by the pound. And they're actually really good tomatoes and they're just in our backyard. They're organic. So of course, people would buy them by the pound. It was great. So that was an easy win. And then one thing that was hard fought was my parents at the age of 7 made me learn piano. And I hated it. And I kicked and screamed and I did not want to play piano. And I was a miserable kid when it came to this. But eventually, I think around 16, I started to like it. And what I actually started doing around that time also was I recognized, piano is a very valuable skill. And so was teaching it. These piano teachers make a ton of money. So while I had a piano teacher who my parents paid money to, I could actually find younger kids in the neighborhood and give them piano lessons. And their parents would be willing to pay $60 an hour to, 14, 15, 16-year-old kid which that's a pretty good hourly rate, especially if you're doing like a 30-minute lesson for a young kid who doesn't have enough attention span. So that's really cool. Something I did. I remember, biking around the neighborhood and doing piano lessons, and then also reaching out to local country clubs and different venues having private events and actually playing piano as like ambiance music. So that was also a really fun experience as well.
Yeah, that's awesome.
Very entrepreneurial. I think that you undersell yourself there.
All right. Next question is, how has your formal and informal training shaped your journey?
Interesting. Yeah, well, it definitely has shaped me a lot, as you guys can tell. And one thing, I'm going to say a joke and then I'm going to kind of talk both sides of it. So I forget who said this, but a famous quote is, I will never let school get in the way of my education. All right. And that obviously implies that I don't think very highly of school, but that's not true because I was fortunate enough to go to a very good school. I went to Carnegie Mellon. So, I worked really hard to get into a good university. And then I worked really hard at university only to eventually, find, in my opinion, a better path and drop out. But with that being said, the school path is such a valuable path. And it's really important to be on that path if you don't know exactly what you want to do. So for a lot of people, they reach out to me. A lot of young people actually reach out to me and ask me advice. Hey, I'm in college, but I heard you dropped out. Should I do the same? Right. And my advice for them usually is no, because unless you already have a plan, you already have a business plan, you have a proof of concept, stay in school for as long as you can. It wasn't until I was getting pulled out of accounting class because my phone was being blown up by Real Deal Accounting did I have to think, hey, I should probably put work first and school second. So yeah, my advice to people is to stay in school as long as possible. So yeah, that's definitely my, I think, nuanced take about being a dropout and all the stigma associated. So it definitely has shaped me.
Yeah, I love that answer. I love that quote. Don't let your schooling get in the way of your education. There's plenty of ways to get education.
Yes.
Yeah. I mean, with the cost of university these days, you get a lot of people kind of dogging that path, but the effort and energy and the leveling up it requires to actually get accepted and then do well. Yeah, I love your take. Okay, final question. What was your biggest mistake and what did you learn?
Yeah, I'm going to borrow from our earlier conversation again, but yeah, I learned made a lot of mistakes on our first deal and learned a lot. And it really is the fundamental truth that, do things when you can, not when you have to, because once we got our first deal, we were scrambling to find the right property management company, to find a loan guarantor, to raise the money. So those all three in itself are massive mistakes that we paid for in one form or another. And we could have prepared much better. So I'll just pick specifically, when starting out, we needed a loan guarantor, and it's totally our fault for not having one prepared before the deal and having a deal ironed out, because what ended up happening, we scrambled at the last minute. And then the loan guarantor that we signed up last minute actually retraded us and in many ways screwed us over. And the reason why is because we didn't build a relationship. We picked the wrong person, and they knew that they had us in a vulnerable position where we had a lot of money on the line. We had to close the deal, and he could extract whatever terms he wanted. And that is unfortunately a painful and costly lesson.
Oh, well, that's extremely valuable information to share. So thank you so much, Rob. It's been awesome hearing from you. How do you want our listeners to know how to get a hold of you or where they can learn more about you?
Yeah, it would be great for people to head over to our website, lscre.com. That stands for Lone Star Capital Real Estate. So on our website, lscre.com, there's a bunch of free resources and ways to learn more about us and get in touch.
Awesome, Rob. Thank you so much for coming on our show and sharing your wealth of knowledge. It is clear you've done a lot of homework and know the financials of deals and everything very, very well. I know that I learned a few things today. So really just appreciate your willingness to share with us. And looking forward to seeing where you go in the next 10 years.
Yeah, thanks very much. I enjoyed the conversation.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on Win, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.